Welcome back to CryptoIQX. Right now, global investors are nervous. Inflation is sticky, debt levels are extreme, and confidence in governments and banks is weaker than it has been in decades. In moments like this, capital always looks for assets that preserve value, reduce counterparty risk, and can move freely across borders. Gold has always benefited from this environment. What is new is that XRP is starting to be viewed through a similar lens, but with modern advantages that gold simply does not have. XRP has properties that make it feel more like cash than a speculative token. It is highly liquid, accessible worldwide, fast, and not controlled by any single government or banking system. Unlike gold, it does not need vaults, shipping, or middlemen. Unlike Bitcoin, it is purpose-built for moving value efficiently, not just storing it. This is why the idea of XRP as digital gold is gaining traction, especially among institutions that care about utility as much as scarcity. When you look at it from an institutional perspective, the choice becomes clearer. Banks and large financial players do not want assets that are slow, expensive to move, or difficult to integrate into existing systems. They want something neutral, reliable, and scalable. XRP can move any form of value across the globe in seconds. That is not a marketing slogan. That is a real operational advantage. Over time, those advantages matter far more than ideology. This is also why we are seeing a growing separation between retail narratives and institutional behavior. While many retail traders argue over price targets, large players are watching infrastructure, regulation, and settlement efficiency. XRP checks those boxes in a way very few assets do. That does not mean price instantly explodes. It means groundwork is being laid quietly. In this environment, patience becomes a strategy. The story of XRP is no longer just about speculation. It is about positioning itself as a core financial tool in a system that is clearly evolving. You have to look at what is happening behind the scenes with regulation and banking power. Right now, the crypto market is not being shaped by technology alone. It is being shaped by who controls yield, who controls access, and who controls money sitting idle. That battle is happening quietly, but its impact will be massive. One of the most important developments is the way lawmakers are treating stablecoins and yield. Banks have made it very clear that they do not want everyday people earning interest outside of the traditional banking system. In the old model, you could park money in a stablecoin, do nothing, and earn a return. That directly competes with savings accounts. Banks fought that model hard, and for now, they won. Under the new framework being pushed forward, stablecoins are not allowed to pay passive yield just for sitting in your wallet. Instead, yield is only allowed when money is actively used. This looks a lot like the credit card reward system. You spend, you transact, and then you get something back. Idle capital earning interest without banks in the middle is exactly what they are trying to prevent. Why does this matter for XRP? Because XRP was never designed to sit idle. It was designed to move. It thrives in a system where value flows, not where money just sleeps. If stablecoins become spending tools rather than savings tools, the importance of fast, neutral settlement increases dramatically. That plays directly into XRP's strengths. At the same time, exchanges are being forced to adapt. Since they cannot offer yield for holding assets, they are likely to shift toward transaction-based incentives. That means more on-chain activity, more movement of value, and more demand for rails that can handle volume efficiently. XRP fits naturally into that environment because it reduces friction every time value moves. This is also where regulation creates winners and losers. Assets that rely on speculation alone struggle when rules tighten. Assets that provide clear utility tend to survive and even benefit. XRP sits firmly in the second category. It is not dependent on hype cycles to justify its existence. It has a job, and that job becomes more valuable as financial rules become stricter. Many people see regulation as anti-crypto, but that is not entirely true. Regulation is anti-chaos. It favors systems that look reliable, predictable, and easy to supervise. XRP aligns with that reality far more than most realize. As banks lose some flexibility and users lose passive yield options, Efficient payment and settlement layers become the real battleground. This is why the market feels stuck right now. Capital is waiting, not because the future is unclear, but because the rules are still being finalized. Once they are, money will move quickly toward infrastructure that works within those rules rather than against them. Right now, XRP is stuck in a strange place where fundamentals and price are telling two very different stories. On one side, development, partnerships, and real-world use cases continue to expand. On the other, the price action looks hesitant, even fragile at times. This disconnect is confusing for many investors, but it makes sense once you understand the political and macro forces at play. A major source of uncertainty is the ongoing delay around clear crypto regulation in the United States. The issue is not that lawmakers are rejecting digital assets outright. The problem is disagreement over how regulation should be structured and who should be held to stricter ethical standards. Political tension has slowed progress, creating a holding pattern for the entire market. This delay has consequences. When rules are unclear, large institutions hesitate to move aggressively. They may research, test, and prepare, but they rarely deploy serious capital until they know the boundaries. That hesitation shows up in price charts as consolidation and failed breakouts. It does not mean the asset is weak. It means decision makers are waiting. From a technical perspective, this waiting period carries short-term risk. If broader economic data continues to worry central banks, risk assets can remain under pressure. In that scenario, XRP could struggle to reclaim key levels quickly. A failure to regain momentum could open the door to deeper pullbacks over the coming months. That is the uncomfortable part of the current setup. However, this is where perspective matters. Even in a bearish scenario, XRP today is fundamentally stronger than it was in previous cycles. The ecosystem is larger, the infrastructure is more mature, and the narrative has shifted from speculation to functionality. Price weakness in this context is not the same as structural failure. On the bullish side, there are signs that long-term interest has not disappeared. Institutional products tied to XRP continue to see engagement, even during periods of price decline. That suggests some investors are looking beyond short-term volatility and positioning for a future regulatory green light. This creates what feels like a purgatory phase. Nothing is exploding upward, but nothing is truly breaking down either. Markets often behave this way before major directional moves. Frustration builds, patience gets tested, and confidence thins out. Historically, that is when long-term opportunities tend to form. The key question investors face right now is not whether XRP still has a future. It is whether they can tolerate uncertainty long enough to see that future unfold. Short-term traders may see danger. Long-term participants may see accumulation zones. Both views can exist at the same time. One of the most misunderstood debates in the XRP community right now revolves around comments made by longtime builders and developers. When emotions are high and price is not moving the way people want, every statement gets amplified and often distorted. This has been especially true with comments about future price expectations and what is considered realistic or unrealistic. A common mistake many investors make is assuming that personal beliefs or past decisions reflect the ultimate potential of an asset. That logic simply does not hold up when you look at market history. Early participants in almost every successful asset sold far earlier than the eventual peak. That does not mean they lacked belief. It means they made decisions based on information available at the time. XRP's own history proves this point. There was a time when a price of 25 cents sounded absurd to most people. Many openly mocked the idea that XRP could ever reach that level. Then the market proved them wrong. During the last major cycle, XRP surged far beyond what the majority believed was possible. The lesson is not about specific numbers. The lesson is about how perception changes as adoption grows. Today, the same pattern is repeating. Some investors dismiss higher long-term price scenarios as fantasy. Others cling to them as certainty. The truth usually sits somewhere in between. What matters more than any single price target is whether the underlying system continues to expand and attract real usage. Price eventually follows relevance. This is where long-term builders play a critical role. Their focus is rarely on headlines or social media arguments. They are concerned with making sure the network functions reliably, securely, and at scale. When they speak cautiously, it is often interpreted as pessimism. In reality, it reflects responsibility. Overpromising helps no one, especially institutions that demand stability. Historical comparison helps bring clarity. Bitcoin faced similar skepticism in its early years. Prominent figures sold long before its largest moves. Looking back, it is easy to judge those choices harshly. At the time, they were rational decisions based on risk management, not disbelief in the technology itself. For XRP, the same principle applies. Statements about uncertainty do not invalidate long-term potential. They highlight how early the market still is. True adoption unfolds slowly, then suddenly. Most people only notice it once price forces their attention. The bigger risk for investors is not missing a specific number. It is abandoning a position because of noise, misquotes, or emotional reactions. Long-term outcomes are shaped by infrastructure, regulation, and utility, not by isolated opinions. As the ecosystem matures, debates about who said what will fade. What remains will be the networks that actually work when the global financial system needs them to. That is where XRP continues to quietly position itself.